Hi, thanks so much for joining in. You're watching the Mutual Fund show on NDTV Profit, and my name is Alex Matthew. Like the name of the show suggests, this show gets you actionable insight on everything mutual fund related, whether it is an equity related strategy or fixed income, as the topic of today's conversation is going to be. Now, we focus a lot of our attention on this platform and otherwise on the equity markets, and frankly, we should be spending a little more time talking about bonds and the opportunities that they present for the Indian investor. And there are so many opportunities available for you in the mutual fund space as well. The context is important to understand because you have a major event that is lined up in the form of the budget for 2024, where you're going to see the roadmap that the government lays out, not just for the upcoming year or this current financial year, but also for the next 5 years. And you will also get a sense of what the market borrowing figure will be, because the government is going to have to borrow a certain amount of money from the market in order to fund its plans going forward. All of that has a bearing on the interest rates that are levied on bonds and basically what you will gain as an investor when you invest in these bonds. Now, to that end, I've got a couple of special guests joining in to talk about how they are employing strategy, and this is fixed income fund managers. I'm joined at the start by Sandeep Yadav, who's the head of fixed income at DSP Mutual Fund. I will soon be joined by Mahendra Jajoo, who is the head of CIO of fixed income at Mirae Asset Investment Managers. Thank you so much, Sandeep, for taking the time, and pleasure having you on the program. At the start, let me ask you, the event that I did not yet speak about and that is already behind us is the inclusion into the JP Morgan bond index that took place on Friday. We have seen quite a bit of an impact in the run-up to that inclusion, with a lot of money coming in from overseas. What is the kind of implication that you've seen so far? Is it completely out of the way, or do we see more of an impact in the months to come?
On the contrary, Alex, this is just a start. This has been the first month when we have seen JP Morgan bond index inclusion being added. This will carry on for next 10 months, where the index will have 1% of the weightage added to India every month. So we've just seen the start. Having said that, are we saying that the flows have still not come in? No. Probably around 30 to 35% of the flows have already come in so far, but a large part of flows are still to come. We believe that there's a little bit of complacency in the market, that probably the news is already there. It's already been priced in. We believe that it's still not priced in. Yields will drive further lower as we see more flows come in because of the JP Morgan bond index inclusion. And I think it's just start of the story right now. There's still a long way to go. And we still remain very positive that bond yields will drive lower as the index flows come in.
Okay. But then talk to me about the inclusion into other indices then. We're only speaking about the JP Morgan bond index, but then a lot of people have spoken about this as the first step into inclusion into other indices. How much of a bearing will that have on the Indian bond market going forward?
So, Alex, I believe it's probably too early to talk about those inclusions. Why do I say that? Well, we already know that Bloomberg has also included India in the index. It's a much smaller size compared to what JP Morgan index flow is, and it probably will not move the markets. The other few indices that we can talk about is probably FTSE Russell. FTSE Russell has still not added, FTSE has still not added India in their bond indices. Why have they not added? Well, it's very difficult to figure out because it's not that it's in public domain, but probably something to do with the taxes, but we are still not sure about that. But I'm not holding my breath that India will be added to FTSE index quite soon. Another index that we can talk about is global bond index. So right now, India is part of the emerging bond index of JP Morgan, but they've got a global bond index also. But for that, India's rating needs to improve. And I don't see India's credit rating really improving in near future. So both, be it FTSE or be it India being part of the larger index, global index, rather than just emerging markets, seems to be a little bit far away, according to me. And probably it's not the right time to put a fixed income strategy expecting such inclusion to come soon.
So we've already seen tremendous inflows, Sandeep, over the course of the last year into the bond markets from overseas. In fact, it's significantly higher than the equity inflows if you think about it. And it's, if I'm not mistaken, it's a multi-year high. I can't remember how far it goes back. You'd probably be able to tell me the data on that. But there are implications there too, right? Where could you see, for example, a major global event having a larger bearing than it has in the past on Indian bond yields?
Actually, no. And this is the good part about the new money which is coming into Indian bonds. If you remember, I think way back in 2013, India had a decent amount of FPI money in the Indian bonds, which we were never able to get back to till the time the bond inclusion came into being. Now, why was it so? Well, so far the money which was coming was active money. People were taking a call on Indian bond deals, and the money was coming in because of that. The money which is coming right now is a very passive money. If someone invests in a JP Morgan bond index tracking fund, then that fund has to necessarily invest a part of that money in India. So even if there's a negative, let's say, global news, or if there's a negative news on India as well, it's not that it's going to lead to the outflow of this money. Probably what can lead to outflow is if the funds which are tracking the index actually reduce in size because of global event. But even if they reduce by 10%, 20%, we are just talking about $2-3 billion leaving India. Whereas right now we are talking about $20 to $25 billion coming inside India. So even if there's a negative event, unlike in previous times when we would see an outflow of money from India, it's not going to happen this time. This is a much more sticky money, and it is probably going to be here for quite some time to come.
All right. Okay. So then from that perspective, and I'm still waiting, we're trying to get Mahendra in as well. I'm quite keen on listening to what he had to say about the questions that I've asked you. But, you said that you expect, and you're bullish, and you expect that the bond yields will continue to move downwards. They've already moved lower from a peak of 7.4 plus or thereabouts on the 10-year. Where do they go from here? They're already at 7%. And that gap between US Treasury and India bonds, if I'm not mistaken, has narrowed quite a bit.
You're absolutely right. The gap has narrowed, and let's face it, very different. India and US are going in a very different path. India is seeing a lot of fiscal prudence. India's fiscal deficit is coming lower. Market borrowing is surprising on the downside. In US, we see a lot of fiscal issues over there. We saw yields spike up on Friday because of the election expectations, and there's a lot of fiscal expenditure happening there. So because the spread has not come down just because people are buying for no reason. Well, there's a reason to buy, and that is that India's fiscal deficit is coming lower, and we've already seen the spread narrow. Now, coming back to your first question, it's already come to 7%. How low? I think a large part of when we ask this question is we look at historical levels and we say, oh, 7% is quite low, it can't go lower. Let me put some numbers into perspective. Right now, if we look at India's overnight rate, it's at 6.5, and your 10-year bonds is at 7%. It might seem that 50 basis points is a very low margin and bond yields can't fall further. But if you take away the times of COVID, when it was an exceptional time and the difference between 10-year bond yield and overnight rate was around 200, 250 basis points, right now 50 basis points seems low, but it's actually not low. If you go back to 2013 era or 2016, it was 18, I'm sorry, when rate cuts happened. The spread had really crashed much, much lower than 50 basis points. So I expect, or rather it had fallen quite a lot. So I sincerely believe that this 50 basis point spread between overnight and 10-year bond yields is not really low, and 7% is really a good buy right now. We have seen 10-year historically go 20, 30 basis point over and above repo whenever RBI has infused liquidity or is in the cusp of cutting rates. While I'm not saying that RBI is going to cut the rates in the next 3 months, 6 months, but I'm saying that the next rate action is most probably going to be a rate cut, and we're going to see liquidity infusion. And in such a scenario, I believe 7% is really a good level to buy. What is my target? Frankly speaking, I don't have a target in my mind right now. But if 10-year yields come somewhere between 670 to 680, I would presume that I would rethink, and at 670, I would rethink my strategy. And I'm not saying that I'll cut my longs, but I'll probably look at the incoming data and again decide what to do.
On that note, it's actually a great time to have Mahendra join in, because Mahendra, quite interesting statements being made by Sandeep, in terms of where he thinks that yields are heading, 6.7% is what he's talked about on the 10-year. And he's talked about a few factors that could contribute to this. I don't know if you heard that last bit, but why don't you weigh in and tell me about what you think the trajectory on bond yields is going to be?
Well, I think I heard the gist of what Sandeep was saying, especially the last part. I think broadly he's correct. It's a fair expectation that the next move from central banks will be a rate cut, not only in India, but across the globe. So we are not only having a very favorable situation in India, but there is a tailwind from the global side. In fact, today I was reading an article that apart from Bank of Japan, there is no other central bank which is expected to hike rate, and most other central banks are expected to cut rates by between 100 basis points to 150 basis points, and so on in the rest of the world. And in India, the economic environment is very favorable. We are perhaps at a cyclical low for inflation, but at the same time, there is a very shallow room for the reserve to cut, because the differentials with the global rates have come down to historical lows. For example, the Fed is 5.5%, we are at 6.5%. So put that in a historical perspective, the spreads are at the lowest that we have known. So therefore, it will be a shallow rate cut from the Reserve Bank. That's how it seems right now. And market has been anticipating a rate cut for over a year now. So a lot of it has priced in. So the last that I heard from him, at around 75, 670, one will review, and we will possibly look for further, easing of the 10-year yield from there. But that would be a very good level to review, continuing the same overweight position that we are perhaps having now in our funds.
Okay, I already asked this question to Sandeep, so I'm asking you as well. The gist of the question that I had for him was, what is the impact of the flows that are coming through on account of the inclusion? And he's pointed out that 30 to 40% of flows on account of the inclusion, the JP Morgan bond index has already taken place. So there is a considerable amount of inflow that is still to come. Having said that, can we see a tightening further or lowering further on account of flows coming in, more demand for Indian paper?
So the JP Morgan news is over a year old. So it's a classic case of the fact the amounts of the inflows purely on account of the JP Morgan bond index inclusion isn't very material in the context of the size of our bond market. We are expecting an inflow of somewhere around 2.5 billion per month on that account, which translates to roughly about 20,000 crores per month. So that is important, but that is not the only driving factor in the market. Right now, we have the all-important budget being presented very soon. We have just about the beginning of the monsoon, and we have to still assess how much it will impact the food and vegetable prices, which tend to be very, very volatile. We are still awaiting some sort of indication from the Federal Reserve that they are ready to start cutting rates, because real rates in US have now widened a lot in the historical context. And then there is a local demand supply balance, which is right now in the favor of the demand, because there is a good demand coming from the pension and the insurance companies. So I think the bond fund flows by themselves are not the driving factor for the market, but they are an important factor, is how I feel about it. Now, if we get more, index providers to start including Indian bonds in the next couple of months, I think that will be far more positive. So that's how I am looking at it. It's an incrementally supportive measure, but not the sole driving factor for the market.
In fact, that was going to be my next question. Sandeep, I'll come to you on this one. The market borrowing number for the current financial year, I guess that is going to be the next big trigger. And in the context of the expectation of the glide path on fiscal deficit, and perhaps this is a little complicated, let's actually simplify it. What is the number that the bond market and you as an investor in the bond market would be comfortable with when it comes to the borrowing figure for the current financial year? And how much of a bearing is that going to have on the bond yields?
Well, to be very honest, me as well as I think a large part of the market is expecting the same numbers that were announced in the February budget, and that is 14.5 lakh crores for the central government, the borrowing. Since the budget was announced, two different events have taken place. Firstly, we have seen that we've got a coalition government, so that might put a little bit pressure on the government to be a little bit more populistic when it comes to the expenditures. On the other hand, what we have seen is that RBI has given about 1 to 1.5 lakh crores of money to the central government as a dividend. I think somewhere both these events net off each other, and we will not see any, in my view, any differences when it comes to the market borrowing. And one final point which I may add is that governments usually don't give a shock to the market borrowing during the budget, at least in the past 15 years that I've seen. And if they would need to increase the market borrowing, they might probably wait for the second half of the year, probably even Q4 of this financial year before they increase the market borrowing. Though I don't see any reason for them to do it, but just in case they were wanting to do it. So a number which is very different to the 14.5 lakh crore number that was announced earlier in February. A higher number will lead to a yields to rise, a lower number will lead to a rally. But I think the base case scenario still remains that the government is not going to tinker with the market borrowing as we stay.
Okay. Mahendra, any probability at all of a lower number considering the kind of amount that was received on account of the RBI dividend?
So, as Sandeep said, there are many events that have taken place. We are living in a very, very uncertain and volatile time, and especially the geopolitical situation across the world is very, very uncertain. So, given that it's a government with a different texture, a coalition where clearly there will be a lot of assistance demanded from the coalition state governments like Bihar and the Andhra Pradesh. So, I think the government will have room to reduce the borrowing number clearly because of the extra dividend paid by the Reserve Bank, which is very, very substantial, and the buoyant tax collections. But at this point, I think it will be, I mean, my expectation is that government will possibly not raise the borrowing number, but we are in a pleasant environment where the market is expecting the eventual borrowing numbers to be lower, and that will most likely turn out to be the case. There's another aspect to this, which is that the growth projections between the budget, interim budget that was presented in February and now are much higher. The final growth number for FY24 are much higher than the initial estimates, and the expectations for FY25 are also higher. Inflation is also somewhat higher than the projections. Therefore, it is possible that with the same borrowing number, the fiscal deficit as a percentage of the GDP is on the lower side. So that will be something to be cheerful for the market.
Okay, so the ultimate, now this is the ultimate question to the both of you. We have a couple of minutes to establish this, and it is the toughest question ultimately. What is the kind of strategy that you're employing right now, and what should investors bear in mind? Sandeep, first to you and then to Mahendra.
Well, there's just one strategy which we're employing now, and what we were employing maybe probably 10 months back, 6 months back, 3 months back, and that is being long bonds, being long duration. We prefer 30 to 40-year bonds more than probably the shorter tenor.
Wow.
Shorter tenor will rally when rate cuts happen. We don't see a visibility of that right now. So long bonds, as much as we are comfortable with.
Okay, Mahendra, you want to add to that?
Pretty much. I mean, we are overweight in each of funds, but we are not as heavily invested in the 30, 40-year bonds anymore because I think the spreads there have collapsed and, the 10 to 40. So given that we are not as overweight in that segment, but directionally, I think at this point it has to be constructive and positively disposed. There is no reason to be negative. Your best case scenario is interest rates remain here or they go down. So therefore, I think at this point, no other way but to remain invested.
Okay, last follow-up question in very little time. So quick answer, Sandeep. Opportunities in credit on the corporate bond side, does the spread tighten there as well? Or are there opportunities as they stand right now for good PSU companies raising money from the corporate bond market?
We prefer G6 to corporate bonds for the time being. 3 months down the line, 6 months down the line, we can revisit the view. But so far where we are, we think gilts are a better point, G6 are a better point than corporate
You want to very quickly tell me why?
Well, firstly, we'll see a little bit of more issuances when it comes to on the corporate bond side. We have already seen corporate spreads are really narrow where we are. And whenever the rally happens, especially when we see bond inclusion flows coming in, it will always be more lopsided for the government securities. The demand-supply dynamics is much more in favor of demand when it comes to G6 than in corporate bonds where we are right now.
Mahendra, what about you? Do you like credit at all?
I think the credit environment is good. We see opportunities in the mid segment of the top 3 to 5 years, and I think the rally in the GSEC is going to be, completely front-ended. A lot of that has already been priced in, and therefore, I think to the extent I agree with Sandeep that at this point one would like to be GSEC overweight, but then there are different types of funds. Some of the funds do not, for example, corporate bond fund, we can have only 20% in government bonds. So there, I think there is a good opportunity to area. The spreads are good, the supply is there, so availability is good, and the direction is positive. So I think there, once initial GSEC movement has happened after the first couple of rate cuts, I think the liquidity will improve and that will make the curve steeper. Right now we have a completely flat yield curve from 1 to 10. So in those kind of funds, we are looking at good opportunities in the 3 to 5 to 7 year segment of the corporate bond.
Got it. All right. Mahendra as well as Sandeep, thank you so much for taking the time. Pleasure speaking with you on NDTV Profit.
Thank you so much.
Thank you so much.
All right. So this ended up being a little bit of a technical conversation on the bond markets, but I hope that you've still gained something for it. My next guest is a face that you will definitely recognize if you have been watching the mutual fund space over the last several years. Sunil Subramanyam, former managing director now of Sundaram Mutual Fund, is joining me. Sunil, you must have watched the World Cup final over the course of the weekend, and you had a few stalwarts of the game announce their retirement. Did you time your retirement to coincide with theirs?
I think it's the reverse. I think they timed it to coincide because mine was in the public domain quite long ago.
Okay, but it presents me with a great opportunity to ask you what you've seen over the course of your career, which has been probably, I would think that a lot of people would be envious of the kind of journey that you've had. Where do you leave the mutual fund industry and how do you compare it with where you started?
So I think that one of the key elements here is that the financial inclusion part, that is the appreciation of equities as the inflation beating asset class. I think when I joined in the 2005-6 period was just beginning. Today, you have a far wider penetration. I agree that the number at about 5 crore mutual fund investors doesn't look very large when you look at 144 crore population. But I think that the awareness of the industry has sharply improved. The SIP book is a clear evidence of that. I think people are recognizing that this is the asset class which you can plan for your retirement in the absence of social security benefits. And I think that even in the last decade and a half, mutual funds as a proportion of bank deposits have doubled from 13% to 27%. So it indicates that that element of seeking only safety as a safety net for yourself to taking on some bit of risk with the equity markets is a big change in the investors' behavior. And that's something I think we need to capture on and take it forward strongly. I think that's one good thing. The second thing which has happened over the same period is India's relative importance in the world markets. If you see as a share of the emerging market index, we're phenomenal. We've got 3 times our share over the last few years. So I think India's growth in the world stage, I think the equity markets have captured it very well. And so that adds to the domestic feeling of pride. So I think that the equities are finally coming of age. Whereas when I started, equities was looked at more like a gambling asset class, only for the rich and the idle rich to play around with their money. Whereas today it is a very middle class, actionable item to plan for the future.
So
I think
Sunil,
that's where the industry is.
So
Sorry.
Sunil, the point is that Mutual Fund Sahi Hai, the campaign that you also participated in, has worked. But what's next for the mutual fund industry?
I think what's next is, first of all, to promote the safety liquidity element of the mutual fund industry. I think all the growth has come from equities, part of it through market action, part of it through SIPs and equities. But I think not enough has been done in promoting the liquid schemes, the debt schemes, the taxation, which was earlier supportive, taking it away has meant that that's slowed down a bit. But I think ultimately the disintermediation, which is what mutual funds are meant to do, which is you lend money to a bank through a fixed deposit, they lend it to a corporate customer, right? The bank taking his share of the pie. The mutual industry disintermediates and takes away that. So it's a huge opportunity for the retail Indian customer to use the mutual funds as a wonderful liquidity cum safety tool. I think there we have a long way to go. And that's why the penetration, I mentioned 5 crores versus 144 crores. I think the next journey of the mutual fund industry is to make it palatable to the India's middle class public as an ideal venue to park your money and not only use it as a vehicle to generate huge returns. I think the industry has a big role to play in becoming the first choice of investment for the Indian middle class. And I think I would like to see the next decade, the mutual fund industry actually penetrate across hybrid products like multi-asset funds, balance advantage funds, liquid funds, ultra short term. I think that's the next path of growth.
And Sunil, thank you so much for joining us. And, just ahead of the start of your next innings, and look forward to speaking to you again not too long from now.
Sure. Thanks a lot. And all the best to your viewers.
Wish you the very same. And that brings us to the end of this particular edition of the Mutual Fund Show. It's been an absolute pleasure bringing it to you. Do stay tuned. Lots more coming up over the course of the day. And this is NDTV Profit.